Hi, and welcome back again to Tim Bigham's Options and Volatility newsletter. Taking a look today, our most recent trade in Beyond Meat and why IV matters, why in this case, IV and term structure of volatility matter, right? As IV and price both got to extremes, and how we profited from the ultimate reversion that we expected to come happen in a couple days. So let's jump in and take a look. First of all, here's the Thinkorswim option scanner I built to identify unusual option activity, UOA, that lifts implied volatility. You can see from Tuesday, right, dominated by Beyond Meat with just massive volume. Different scanner kind of puts it all together, right, instead of by the individual strikes here, which is very nice. But this shows just how much volume, over 2.5 million option contracts traded versus under 65,000 average, almost 40 times the normal volume. Incredible to say the least, and huge volume just on a number basis, right? You can see the stock ripping higher, right? It actually came, off the highs the next day and closed lower on the day, which was when we put the trade on. But you can see implied volatility now at the 100% level, which means option prices hadn't been this expensive ever over the past year. So that's set up ideally for a couple trades here. Here's that jump in implied volatility. You can see that huge rip higher. Here it was from basically Monday to Tuesday's close, even heading higher. Here it is on a longer look basis. You can see implied volatility a couple weeks ago was actually under 100. You can see it crept higher, and then the huge explosion recently. More importantly, I think the calls now trade at a higher IV than the puts because Beyond Meat was hard to borrow, right? Heavily shorted, right? The out-of-the-money puts traded at a much higher V than similar out-of-the-money calls. But because the short squeeze started to happen, everyone racing in to buy these calls, right? Set up ideally for a trade for that vol reversion, right? And also the fact that they took the stock to levels that almost always inevitably fails here. Here you can see that massive volume, as we said, as short-term especially. So we're looking to sell the short-term options. In this case, we did the October 31st and buy more reasonably valued November 25th options. The reason behind the story, Walmart going into or Beyond Meat going into Walmart stores, which I don't really look at that as a great fit. Walmart shoppers, I don't want to say it, but aren't the most health conscious, in my opinion, which is kind of the, vegetable based, if you will, Beyond Meat, plant based, pseudo protein, right? Plus, even though the cost has come down with the alleged value pack, right? It's still much more expensive than regular ground beef by a decent amount. So that combination, I don't think the Walmart news really was anything that was going to be hugely beneficial, right? But it did trigger the run in the stock. We can see just how much. Here is that stock ripping higher right when that news story came out. That's the day we put the trade on, October 22nd. And we'll see in a second, we put the trade on the stock around 6, right? And it did close lower on the day. So certainly set up ideally for that trade. So here's the actual trade recommendations. We said going out and on October 22nd, right after the opening, buying the November traditional $4 puts, selling the October 31st, the shorter term ones where the IV's at, right? $3.50 puts. So leaning bearishly, right? And capturing vol. We like that combination a lot. Paying just 53 cents for a 50-cent wide spread. Here you can see the actual trade, right? Pulled one off here. So buying the November 4 put at $1.52, selling that shorter term October 31st 3.5 put for 99 cents. So paying 53 cents, right? 2 deltas net short, right? Buying a negative 16 delta on the put we're buying, selling a negative 14. And here is the big reason, as well as that vol spike we just saw. Term structure vol, short term October 31st expiration put, trading at over a 700 IV. The one we're buying in November, certainly expensive at basically around a 450 IV, but that term structure vol, in other words, the difference between the option we're selling at 725 and the one we're buying at 460 roughly is over 260 vol points. Enormous, to say the least. So that's another way we look to identify very nice trade opportunities here. The fact we're able to sell this option at such a high IV means it's a very richly priced option. By selling it, we lower the cost on the trade to just 53 cents, right? Stock was at $6 at the time here. We can then take a look at the chart. As we said, here's that day we put the trade on. The stock right around $6 up here. It did trade much higher, but actually reversed to close at near the lows of the day at under $4, right? So certainly this kind of key reversal many times indicates the short squeeze got out of control, and it certainly did here, to say the least. So we can also take a look at what happened as far as the closeout, right, once that IV reverted. So when we look at the reversion coming on the IV on Beyond Meat, right, we can see here's that reversion on Friday where it finally started to come down. Here's that drop from Thursday to Friday. Here is that on a basis that we looked at before where we were able to sell up here, right, IV, cover it when it dropped back down to still a very high level, but dropped very sharply indeed. You can see volume starting to dry up. So that led to the closeout on the trade, right, where we recommended on Friday again, right after the open, to close out half for a very nice gain at 83 cents. Play the remaining half for potentially more. Here is that closeout, right, where we're able to sell it at 83 cents, right? The delta now, 9 deltas net short because the stock did drop from just over $6 to just under $3. So basically around a $3 drop in the stock. But that term structure of vol, right, has flattened dramatically, right? We were able to sell it at over 260 up here by selling that 725 IV. Now here it's dropped, as you can see, to just, and I do say just, 481. Our one we're long did drop, but not nearly as much, 394. So the term structure of volatility flattened by almost 180 vol points, or about 2/3, right, on the trade. So we're able to close it out, as we said, at 83 cents for a net gain of 30 cents. Based on the 53-cent entry point, that's a very nice over 50% net gain for 2 days held, in on Wednesday, out on Friday, right? So our smooth delta was minus 5.5 deltas, right? Because we are 2 deltas net short at inception, 9 deltas net short when we closed out half. The stock did drop 3.5 points, so we'd expect from a delta perspective to make about 16, 17 cents on the trade. We had a little bit of theta our way, right? The shorter term ones decayed a little bit more, a penny or so a day, than the ones we were long. So net we'd expect to make about 20 cents on the trade, but we actually were able to make 30 cents. Why? Because of that term structure volatility flattening our way very nicely indeed. So really goes about showing why using implied volatility, understanding implied volatility, can be such a big component of option trading, why we do it day in and day out here. So we have the other half open there. We'll see what happens on that. And we have plenty of the weeklies, right, to continue to do what I call chop wood, right, to keep rolling it forward November 7th and the 14th, bringing some more premium if we want to, by rolling those 2.5 puts. And if we can do it for about 25 cents each week on the roll, we can have the trade for free at the end of the day, the remaining half. So took a gain of over 50% on the first half, and it's marking up positively now as well. We can see, where it's at now, that 3.5 put in October, the one we're short trading about $1.50, and that $4 put, right, trading at about 225. So marking up right around that 75, 80 cent level, right? So we got in right around 50. So we could close out half now for about another 50% gain, about where we got out, but we'll look to play half of it simply because we're starting now, as October 31st gets into expiration, right? We'll lose 2 cents a day on the puts that we're long, right? But on the ones that we're short, we'll start to pick up much more as we get closer to expiration. That theta decay will head our way as well. So hopefully provides insight. How do we go about identifying trade opportunities here in a defined risk way? Until next time, as always, here's a good